This video is purely for educational purposes and does not constitute financial advice. Please consult a SEBI-registered advisor before making any investment decisions. Our analysis relies strictly on the data filed in the company's official prospectus. Liotech Industries Limited is raising capital through an SME IPO. They are looking to secure 3,601.62 lakhs in a 100% fixed price issue. Liotech operates as a heavy metal B2B manufacturer, and they are using this public offering to finance a massive operational leap. The prospectus outlines an aggressive top-line growth narrative. To price this offering correctly, we need to determine if their underlying financial and physical machinery actually supports those projections. To do that, we have to strip away the marketing language and trace the incoming capital directly down to the factory floor. Liotech operates its entire manufacturing base out of a single 12,632 square foot facility located in Rajkot, Gujarat. Inside that space, they produce industrial and architectural hardware. The product line covers over 150 specific variations of raw stainless steel hinges, door kits, tower bolts, and heavy fastenings. Their output is absorbed by macroeconomic infrastructure sectors. They sell directly into housing, automotive manufacturing, and solar power installations. This flowchart from the prospectus outlines their revenue model. The business operates on two distinct tracks: in-house manufacturing and the direct trading of supplementary hardware products. Because Liotech operates as a strict B2B supplier, they do not benefit from retail brand awareness. Their margins and survival are entirely tethered to industrial volume and supply chain efficiency. Looking at their historical operational efficiency, the Rajkot factory is running hot. Between fiscal 2024 and 2025, actual capacity utilization hit roughly 84 to 88. The primary goal of this IPO is to shatter that ceiling. The management team is attempting to radically expand their production limits. This animated bar chart tracks their installed capacity in metric tons. You can see actuals starting at 619 tons in fiscal 2023 and projected capacity surging to 4,759 tons by fiscal 2026. That represents a 7.6 times explosion in physical volume squeezed into an incredibly tight timeline. This makes the IPO a clear capacity wager. By buying these shares, investors are financing an aggressive physical scale-up, betting that Liotech can secure enough new purchase orders to fill that massive future capacity. We can verify this strategy by moving from the factory floor to the capital table. After expenses, the fresh issue provides Liotech with exactly 2,428.20 lakhs in net proceeds. This table breaks down the formal utilization of net proceeds into three operational buckets. First, deploying 800 lakhs for new stamping machinery. Second, allocating 495 lakhs to pay down secured loans. Finally, 700 lakhs earmarked strictly for long-term working capital. The capital allocation aligns with the capacity wager. They are buying the hard machines to stamp the metal and securing the liquidity required to keep those machines running. This financial summary shows aggressive top-line momentum. Revenue from operations spiked nearly 46%, moving from 2,786 lakhs in 2024 to 4,067 lakhs in 2025. Looking down, restated profit after tax leaped to 416 lakhs in fiscal 2025. At the same time, their PAT margins expanded from a meager 4% in 2023 to 10.24% by 2025. But high profits on paper mean nothing if the cash is trapped in unpaid invoices or unsold inventory.
We have to test the quality of these earnings. This side-by-side comparison charts restated PAT directly against net cash flow from operations over the last 3 years to verify cash conversion. The recent data confirms a healthy conversion rate. In fiscal 2025, Liotech recorded 416 lakhs in profit and successfully pulled in 382 lakhs in actual operating cash flow. The historical profits are real, and they are converting to liquid cash. However, scaling this machine to target capacities requires fighting a massive gravitational pull. Heavy manufacturing suffers from a working capital paradox. To sustain hypergrowth, Liotech has to tie up immense amounts of cash in physical inventory before a single rupee of profit is realized. Their inventory holding periods dictate that cash is locked up in raw materials for 10 days, sits in work in progress for 23 days, and waits as finished goods for up to 30 days.
Because this is a B2B operation, once the product finally ships, Liotech waits anywhere from 44 to 64 days to actually get paid by their clients. This cash drag explains the IPO allocation. That exact cycle is why they are asking public investors for 700 locks in long-term working capital. In heavy manufacturing, aggressive growth is expensive. The faster you scale production, the more cash remains trapped inside your own supply chain. Before pricing the stock, investors must weigh the structural vulnerabilities listed in the prospectus. The primary bottleneck is geographic. 100% of their production relies on that single facility in Rajkot, leaving them heavily exposed to local infrastructure failures or civil disruptions. Second is commodity risk. Their margins are entirely dictated by volatile input costs, specifically the open market price of stainless steel coils and rods. Finally, there is the demand forecasting risk. A 7.6 times capacity expansion becomes an expensive liability if B2B customer orders are delayed, reduced, or canceled outright. Liotech operates a highly efficient machine, but it is inflexible. There is zero redundancy built into the model if local conditions or macro demand falters. That brings us to valuation. The promoters opted for a 100% fixed price issue, bypassing the open market price discovery process entirely. The asking price is firmly set at 321 rupees per share. Based on their fiscal 2025 earnings per share of 13.88, management is demanding a price-to-earnings multiple of approximately 23.1. This table tracking average return on net worth justifies that premium, showing a 39.86% return in fiscal 2025. But scanning further down the page reveals a critical clause. There are no listed companies engaged in developing a similar line of product. For an investor, this creates a severe blind spot. You cannot run a comparative valuation against a direct public competitor. You have to price this asset in an absolute vacuum. The bull case for Liotech is straightforward. They are a highly efficient, cash-converting hardware engine, utilizing fully funded capital to attempt a massive 7 times capacity expansion. The bear case is equally clear. The operation is bottlenecked by a single geographic location and anchored by heavy, unavoidable working capital requirements. The core tension of this IPO comes down to evaluating a 23 times PE multiple without a single listed market peer to act as a benchmark. Investors must ultimately decide if Liotech's historical ability to scale operations efficiently justifies paying a premium, standalone price for its future potential.